Good morning. I believe you all can hear me now. In fact, you probably got a supplementary reading that I was referring in one of our last discussions last week, more precisely. So that details most of the details in terms of the concepts, definitions that you will come across in this exercise, and some of the details in terms of what we probably be doing, right? So there's a small description. Give me 1 second. There's another presentations to be uploaded. So once that's also done, we will continue. Yeah. Right. In fact, we were just sharing few slides with respect to a new presentation. My understanding is IBSL still have not shared that presentation with you all. That is the presentation now you are seeing on the screen. That is about money. They'll be sharing with you all in a few minutes. They will upload it. That for some reason they could not share with you all yesterday or day before. Anyway, still we have the discussion with respect to the financial system we were discussing over the last week, and together with that there was a lecture supplement. I remember I have shared that also with the IBSL. They probably be uploading for your information. As I said before I move on and discuss with details, if you have any queries, any questions, I would appreciate you can raise it now, or for that matter, you can still put that in black and white and share over the message screen. So we'll be able to follow up on the basis of whatever that you wanted to clarify. I hope you all are hearing me loud and clear.
Yes, sir, we hear you loud and clear. Good morning, sir.
Right. So you see, we have talked about these structure of financial markets, and mainly we were talking about direct finance versus indirect finance. You are familiar to the extent now. Indirect finance is the financial structures that channel through financial intermediaries. There you probably not necessarily see that the original investor and the original fund user meets each other. If not, the investor would not know where his funds are, but the financial intermediary would know where his funds being channeled. But even in that sense, financial intermediary would not know whether it is party A's, party B's, or party C's funds being channeled to an investment that he is lending out, because its funds all comes and pooled into one kitty, if not one basket, and then from that they channel it out. It's like water pouring into a tub, and that tub would contain, let's say, 100 of taps being open, and at the same time there's an outlet through which the water would flow out. So that water would fall into a particular investment or a borrower to whom the financial intermediary has channeled. So that's the financial intermediation playing a major role in the middle in terms of indirect finance in financial markets. And from a direct finance perspective, you find household businesses, government, foreign investors, they all invest directly on shares, they are directly on bonds. They know who's the one who's investing to great extent. And even if that exchange hands after some period in the secondary market, still, I mean, the owners would be recognized. So it's a mode of directly funding or bilaterally funding, right, or multilaterally funding some source of economic activities through some direct recognition identification exist. So that's a direct mode of financing. So you will now have the kind of a meaning in terms of direct financing and indirect financing, but going forward you will come to know to the extent that which one is dominating in financial markets. So in the globe, if you look at the financial structures, which one is dominating? You will get to know these details as we move on in this discussion. So I'm just highlighting the different elements of this financial market structures. We discussed about the equity and debt market, similarly a primary and secondary market, and to the extent we talked about exchanges, and then we touched upon so-called over-the-counter transactions, and reasons for over-the-counter also discussed. And we looked upon the money and capital markets, where the money market means to say the short-term financial instruments, short-term debt instruments trade in money market, whereas capital market is open for longer-term debt instruments and equities. Equities is, in other words, the shares that trade. Then we try to kind of see some differences in terms of money and capital markets in terms of basic features, duration, short-term versus long-term that we discussed, and similarly nature of funds that comes to this market, instruments trade, and the volumes that you might come across, institution risk, transactions, existence of brokers, and basic role is to facilitate liquidity in the short-term market, that's the money market, whereas in capital market you find the basic role is to facilitate capital formation. That's to say that long-term financing of project activities. So that's a very important aspect of sustained economic development all around the world. So to say that capital markets efficiency is very important in terms of sustaining economic growth in any country. So then you see a market regulation. Yes, both markets being regulated, but the role played by commercial banks is quite significant when it comes to money market, whereas the capital market you find institutional investors, EPF, ETF, National Saving Bank, insurance funds, right? Those play a big role in capital market, even in Sri Lanka. Similarly, all around the world, those institutional investors play a big role in capital markets. Commercial banks also, based on their investment funds that they manage, they also play a role. But commercial banks play a bigger role in money markets to highlight. So these were the elements that you need to, and you try to kind of see these two segregation and features. This is very useful for you to put things in nutshell. So this being said, we also look at some principal major money market instrument in the case of US, and this evolves with changes to the market and things like that. You see treasury bills remains the most sought after money market instrument, not only in US but across other parts of the world too. And you see CDs, certificates or deposits, commercial papers, then repos, repurchase agreements. These are short-term transactions. Repurchase, that itself say you sell today with the agreement to buy that asset back within a short duration. Why you sell today is to facilitate, let's say you have asset, you have a bond, long-term bond. You don't want it to completely sell that off and raise money, but you want some liquidity for short-term requirements. So what you do is you part means you segregate that assets from your portfolio and give it to somebody, sell it to somebody for a shorter duration, and you agree with that buyer that you will buy back, let's say in a week, month, or even overnight. That means today you sell, tomorrow you get it. So this is a very popular product. And in the money market, huge volume of transactions happens for repurchase agreements. You simply call it repos. You sell it short term with the agreement to buy it back in a second leg of the transaction. So this is also one of the prominent money market transaction that you will come across. In Sri Lanka too, this is one of the big volume transactions. You can read Central Bank's annual report. These details, chapter 8, you will see the volume-wise details also provided in terms of outright transactions, repurchase transactions. Repurchase transactions are manifold even in the case of Sri Lanka. So you see the money market transactions, money market instruments here, and then you see capital market instruments and stocks trade. This is the dominant aspect. In the case of Sri Lanka, you don't see much of corporate bond, residential mortgages. These are not that popular in Sri Lanka, but in US, those were one of the major assets classes that's traded in the the capital market in the US and most of the advanced economies. And then in the case of advanced economies, agency securities like municipal bonds, right? That also trade. Local government bonds, that also trade. For instance, Colombo Municipal Council, Dehiwala Mount Lavinia Municipal Council, if they can issue bonds, yes, that could trade. But unfortunately, in Sri Lanka's case, those are not yet in existence. There were efforts to some extent, but those were not realized to great extent for various reasons. But what you are basically seeing is the capital market instruments are mainly concentrated among bonds and shares to great extent, and these are big volumes mainly participated by so-called institutional investors and long-term fund investors, including pension funds. So you can see the kind of a composition and type of instruments exchange hands in the money and capital market. Any questions? Right. So if you have questions, as I said, you can share with me, or you can actually unmute and you can speak. Then we can clarify if you have any questions to clarify. So we were basically talking about the markets, financial markets, and segregate into money and capital markets. And then you see this aspect, so-called internationalization, because you know that the markets are no longer operates in isolation in today's financial world. So markets are actually interlinked, whether it's domestic or offshore. That means outside your boundaries. Markets are linked to great extent. The markets makes this linkage and thereby facilitate efficient fund flows. Inflows, that means funds are coming into your country. Outflows, funds are moving out of your country. And these makes the policy authorities, policymakers also to mindful that your policies are efficient and with rationality being introduced. So that itself makes discipline in the marketplace to great extent in terms of sourcing resources for efforts. So you can see these elements play a big role in financial markets, and the internationalization is today you don't need to actually talk about these things separately, in my view, because the markets are so much integrated, so much linked with all the requirements in the world, and you cannot survive. I mean, even the countries which had more closed kind of environment, I don't think Cuba is also closed now. North Korea, of course, they have boundaries, and through boundaries things move. It's not necessarily closed as such, but they are not yet open out to rest of the world in terms of financial linkages. So that what you are basically seeing here is what we wanted to mean here is so-called financial integration is so powerful that the markets are basically very, very integrated into your economic well-being. And if you make rational, efficient decisions, markets will reward you. But at the same time, if you are making wrongful decisions, market would punish you. There is no excuse as far as markets are concerned, because markets move on the basis of profit. Where the arbitrage is there, they would move and clear those arbitrage very fast. So that's what we are seeing. I mean, the financial crisis, all what you will discuss and what you are to some extent aware now is because of this element. Because you find if your market is not necessarily functioning properly, you might find that the funds that can move out very fast. So that would create a lot of difficulties for the economies where they do not manage their affairs proficiently. So that's one element. And also there may be circumstances, natural disasters that might lead to circumstances that you cannot cope with. Similarly, the pandemics, what we are now seeing all around the world, most of the frontier and developing markets facing challenges because of this, because they don't have policy space. You have in advanced economies some policy space. They could expand their budgets where they can finance the deficits. But most of the developing economies, already their budgets are too big to manage. So further expansion is not possible, but they don't have avenues to source resources also. So these are the challenges. I mean, you had to go through these challenging times. And even in Europe, even in advanced economies, after the financial crisis in 2008-9, they had to tighten their belts. Actually, they have cut down salaries of employees who are working, and thereby number of measures. So the internationalization of financial market is so important in today's context that the financial markets cannot operate in isolation. So you could see these developments in the international financial markets, where you will come across assets and they've been called foreign bonds. Okay, foreign bond is sold in a foreign country. For instance, if Sri Lanka is selling its bonds, let's say in India, okay, and denominated in Indian rupees, it's a foreign bond for India. Right? So Sri Lanka is selling this. So what's the feature here is it has to be marketed, if not transacted in the foreign jurisdiction and denominated in that country's currency. So US dollar based Sri Lanka's ISBs, international sovereign bonds, ISBs, are sold outside Sri Lanka, but not in US. There are restrictions. So it's not a foreign bond as such, but we will come to that. That's a separate definition is there for the international sovereign bond issued by Sri Lanka and trading everywhere, but not in US. But interestingly, foreign bonds are the ones which sold in a foreign country and denominated in that country's currency. So Euro bond, what is Euro bond? Bonds denominated in a currency other than that of the country in which it is sold. So if it is in Eurozone, if it is not denominated in Euro currency, it is a Euro bond. And Sri Lanka's ISBs are denominated in US dollar and sold in Europe, Asia, Middle East, Africa, but not in mainland US, simply because there are regulatory limitations in terms of selling such. Still you can do the selling, but you have to then go through Securities and Exchange Commission regulation and US capital market regulation. That requires a lot of further work to get US investors directly attracted. But Eurobonds, the US investors can invest through another channel. So there are ways and means through which those investors access these bonds. But interestingly, what you have to understand when you say Eurobond, it is a bond denominated in a currency other than that of the country in which it is sold. If it is sold in India, if it is in US dollars, euro, sterling, pound, any other currency other than Indian rupee, it is a Eurobond, right? So if it is in a Middle East, if it is in currencies other than Middle Eastern currencies, it's a Eurobond. If it is in Asia, it is sold in all the Asian markets other than the currencies of those Asian countries, it is a Eurobond. So what you are basically seeing is most of the developing, emerging, frontier market countries and even the developed countries, they used to sell US dollar-based, if not Euro-based, other foreign currency-based bonds in the international markets are mainly Eurobonds. So they basically denominate those bonds in currencies other than the country in which it is sold. So we are not selling in US, but denominated in US and sells everywhere else other than US. Right? So there are elements of arrangements there, but you have to understand this is one of the main elements of sourcing international capital in most of the middle income countries. So as you see that your economy's per capita incomes or the income increases, your access to concessional, that means low interest cost, financing from multilateral and bilateral agencies like World Bank, Asian Development Bank, right? There are various other organizations become rather small, but you require to make your funding through market arrangements, so you have to issue bonds. So that's what most of the countries do. And through that arrangement, you raise capital and through which you basically fund your development activities. So the Eurobonds are the most famous ways through which most of the countries finance, but at the same time, foreign bonds also possible, right? So if Sri Lanka wants to sell US dollar-based international bond in US, so it's a foreign bonds to US investors. So that's the difference. You are seeing foreign bonds and Euro bonds here. When you say Euro currencies, right? Foreign currencies deposited in banks outside the home country. This is very important. US dollars are held everywhere in the world. Okay, so even US banks operating in rest of the world have US dollar deposits. So these are effectively called Euro dollars, but it's a part of Euro currencies that you talk here. Euro currencies is foreign currencies deposited in banks outside the home country. If Sri Lankan rupee is deposited in India, it's a Euro currency. Sri Lankan rupee is deposited in Singapore, it's a Euro currency, right? Outside the currency of jurisdiction, Sri Lankan rupee in Sri Lanka, but if that's been kept outside Sri Lanka in banks' accounts, it is a Euro currency. But more clearly to say, throughout the world, Euro dollars are maintained. Euro dollars, US dollars deposited in foreign banks outside US or in foreign branches of US banks. So it's a very common because most of the countries wanted to keep their reserve assets in US dollars because the currency of global interaction in exchanges, trade, is often US dollar, but other currencies, major currencies too. But most of the countries keep US dollars, and US dollars being kept outside US is $0. Similarly, euro currencies, your own currency being kept outside your own jurisdiction. So any sterling pound accounts maintained outside UK is a euro currency. So you can understand these small variation, but these are very meaningful and very helpful to understand the movements in international financial markets. Then you have world stock markets. Very important in terms of measuring economic health all around the world. You find every day the financial business channels highlight the movements in global stock markets, because that itself shows the sentiments. Sometimes you find markets closes in US and opens from Asia. So people are very mindful to see what's opening in Japan in the early hours, to see what's the direction of financial markets take in terms of what possibly come out, let's say yesterday when the US markets were closing. And when it comes to Sri Lanka, we are more or less in the middle. So we close business by around, let's say, 5 o'clock in the evening. So that's pretty much around 5 in the US, early morning. So markets are not yet open. So by the time Sri Lanka ready to have their dinners or whatever, the US markets opens. So we get a kind of a feel what's the possibilities of developments there. And similarly, before we start, Japan is 3.5 hours ahead of us. Singapore, Hong Kong is about 2.5 hours ahead of us. UK, Frankfurt, that's Germany, it's about 5 hours behind us. So you just keep a kind of a close eye on these markets. What's the direction the markets are heading? So that would signal the behavior of financial assets in the financial markets. Very important, because you probably plan to sell, let's say, government bonds. You want to make the announcement, right? So we often makes the announcement 5:30 early in the morning if we are going to the market, because we wanted to see the opening of Asia being tapped, and we make the announcement. But sometimes we don't make that call. We wait till 7:30, 8 o'clock in the morning to see what's the opening in Asia, whether it is bullish, that means to say it's healthy, strong. So then you probably see market would take our issuance also favorably. If not, the market opening itself makes a lot of noises, volatilities, you probably revisit your decision to open on that day. So there are various ways of looking at these global financial markets movements, and the world markets are so much driven by a lot of information and other developments. So monitoring analysis of these markets are very useful and important. And from another perspective, you are learning these subjects, these programs, at least to kind of feel what's going to happen, what's happening, and how to interpret those from a rational perspective. These are part of the objectives of these programs. And learning these would really help you to get a kind of a little feel where the financial markets are, how the financial markets behaving and expected to behave from a broader perspective. So it's not only for the exam purposes. You will have a lot of benefits through learning this type of subjects with a kind of international feel. So we come to more or less some details of functions of financial intermediaries, banks, insurance companies, non-bank financial institutions, all financial intermediaries we are talking here, right? So any question before I move into this section of discussion? Right. So you see, I mean, the elements that we are discussing here is again quite interesting, because financial intermediation facilitate many efficiencies in financial markets. First and foremost, you see indirect finance. You already know the financing being channeled through financial intermediaries in the indirect finance, and you mainly see that the financial intermediaries facilitate lowering the transaction costs.
Hello.
Right? So it is very important. You assume yourself that you wanted to do your transactions on your own, not financial intermediary. So you have to find somebody who is ready to, right, ready to invest your funds in a project. So you have to search parties in the financial market, so in the society, who has a project proposal that matches with your desires, your intentions of investing. Right? So even after finding, you probably wanted to find out how serious that borrower, right? How serious his project is, what safeguards that you have. I mean, it's very time consuming, and also you have to spend resources to search, find, analyze. If you have some background in financial analysis, you can do it on your own, but still you might require to have obligations being established. So you have to spend money. That facilitate across the board through their specialization to lower all these time and money spent. So to say, it reduces the transaction costs. So you find the banks or any other financial intermediary sitting in the middle, and they facilitate you to bring and save without any hassle or any other consideration, because they have already established. That does not say that you should not mindful of your investments. You have to be very mindful. You have to be mindful of the fact that financial intermediaries also would attract your funds by paying you higher returns. Higher the return, higher the risk. Please understand the correlation. Lower the risk, lower the return. So if anybody is paying more than what's the market average that you come across and familiar with, there is an element of higher risk in that avenue. So you have to give a little thought and you have to analyze. If you are ready to accept it, fine. But blindly going and investing just because somebody is paying 2% more, 5% more, and then you end up with a lot of difficulties if those agencies do not able to perform. What it means is, if they source funds at a higher return from you, they have to invest those funds at a much more higher return to get that return and distribute among you all after keeping all the margins required by them. So these are very important aspects in financial literature and the financial learning. So you find the financial intermediation help reduce the transaction cost through so-called economies of scale, because they are not only doing for you, they are doing for many, many thousands of customers like you. So they have established arrangements, they have established infrastructure, they have established market analysts, they have established contractual, legal, and other documentary expertise. So it's a one unit that you in their entire exercise. So the unit cost involved in you engaging a transaction with financial intermediary is very small. right? So they have established to say that the economies of scale benefits being distributed to the society or the economy. Then liquidity services. When the markets does not have liquidity, you will come across what's the meaning of liquidity in coming discussions. That is to say, how quickly, how fast you can convert your assets into a more liquid form of cash without incurring transaction cost, significant transaction cost, or reduction in value of the assets, right? So the financial intermediaries facilitate both these scale benefits as well as liquidity benefits. So thereby, financial intermediaries, one of the major functions is to reduce transaction cost through scale and liquidity benefits. Then the financial intermediation also look at ways and means through which they can reduce the exposure of investors' risk, right? So you see, I mean, reduction of risk through risk sharing. So it's not that they invest only your assets in one type of a project. You save, let's say, with a financial intermediary. So those savings would not be directed to a one type of a project by the financial intermediary. They have allocation of their assets based on certain risk parameters, right? So some they take risk free, like government assets, treasury bills, treasury bonds. Those are default risk free. We discussed about this. So that's the lowest risk that they could have in a financial market. Similarly, they have so-called prime customers, top customers of those financial intermediaries. They have established cash flows and very strong assets portfolio. So they distribute part of their assets in those books. And they also look at ways and means of lending to the market economic agents. So part of them are highly credit-worthy investors. Part of them are up and coming, right? New investors. So the risk being managed. So your funds being not channeled straight away to one type of investor. It's being shared across. So through which, if anything happens to one type of investor in the market, would not necessarily expose your entire savings with the financial intermediary. So that's been shared across. So the financial intermediary is capable of managing such possibilities in their portfolio because they get a return based on the risk profiles of those investments. So higher the risk, higher the return, lower the risk, lower the return. So they probably match those and facilitate some certain percentage, lower percentage every year in their books for non-performing assets, because some assets they purchase, if not invested or lend, would not necessarily perform. They would not honor. So that also there, but they are mindful of the fact that that share to be minimized at all the time, and they work through various ways to manage those. And financial intermediation also reduce the investor risk by diversification. They don't put all eggs in one basket, right? They pick and choose assets of different risk categories, and through which they can manage. For instance, they are not only investing in, let's say, tourism and travel related assets. They probably distribute that across healthcare, then of course transportation, then of course they look at real estate, then of course they look at real financial assets, right? Agriculture, then electronics, and of course ICT, various levels of diversification in their portfolio, through which when something like COVID happens, the international travel and tourism has hit the most. And they probably worried about those investments, and they are facilitating through number of ways. But they are mindful of the fact that the other sectors are now performing. Healthcare is doing well, real estate is doing well, right? At the same time, other elements of economic activities, even agriculture, is doing reasonably well. And also, to some extent, a new type of economic activities, right? All the online services, things are really coming up, right? So these are the ways through which they reduce the investors' risk through diversification. So financial intermediaries have much more broader space in terms of facilitating this. Similarly, the financial intermediation is deal with another very, very important concept in the entire course that you are learning in this semester. That is the asymmetric information problems. Asymmetry in information. Not all parties to transactions have similar or same amount of information. That's the asymmetry. Parties to transactions have different level of understanding, different level of analysis, and also different level of access to information. So the information in financial markets is key, very, very important. That's what makes markets to move, markets to behave, markets to collapse, right? So this asymmetry of information problem is dealt very effectively by the financial intermediation. So there are two elements here. One is so-called adverse selection. That happens before the transaction. So the transaction, before you entering into a transaction, you have to be mindful of selecting the right party to the transaction. So this happens before the transactions because you try to avoid selecting the risky borrower. So all the borrowers that comes to financial intermediaries has some risk element in their project proposals. All the assets you invest has a certain element of risk associated with that particular asset. But you have to pick and choose what's the ideal risk composition for your investments. So the adverse selection refers to the fact that you have to have established, if not very efficient arrangements through which you screen the borrowers, because most of the time the borrowers would come and propose borrowings with the element that would hide the effective risk characteristics. So we will come to so-called lemon problem. That's a used car market. We will discuss those stuff as we move on with all these arrangements. That's a famous lemons market, used car market discussion in financial markets, where the status or the condition of the car is very much known to the parties who are using it, especially in the second-hand market. So that would create a doubt in the first place in the minds of the buyer. So he would always ask a price below the value, general value of those. So every car in the used car market probably carries that price disadvantage, whether it is in good conditions or not. because that has been already tagged to say that some element of riskiness is not possible to measure other than knowing to the parties who's the seller of that vehicle. Similarly, health insurance. I mean, you know your health better than everybody else. Still, you could do medical examination and things like that. That's why sometimes when you go and submit medical reports and things like that, the organization would not accept those medical reports unless that medical report comes from an organization or a medical laboratory registered and recognized by that organization. So they have certain ways through which that they screen these possibilities. So the asymmetry in information could happen through adverse selection. So before the transaction itself, you have to make sure you do not select the riskiest borrower, right? So you do some arrangements. So you gather information, analyze, you have other ways and means to measure these things, even the models in today's financial world, right? Simulation, stress testing, various ways through which that you screen the elements of adverse selection. Then even after the transaction, moral hazard. You have a godfather, so you don't take required preventive, if not certain measures that requires of usage of a production of a factory, or for that matter, even you could see this after the transactions. You become a risk lover simply because you have a fallback. You have a full insurance for your vehicle, so you are carefree. You don't care about the motor vehicle. So then the tendency that you will get into accidents is greater. You are not worried because somebody else is there to pay for you. So moral hazard. It's like, again, if you are using a vehicle provided to you by an organization or somebody else, you will be a little carefree compared to you are using your own vehicle. Not everybody, but I generally see this type of behavior. Then if you have borrowed from a financial intermediary and the machineries required certain hours of rest after a complete running, if you have orders to provide, you're probably not worried about that required rest for the machines as well. You would continuously run, and thereby you will reduce the lifetime of that machinery, irrespective of the requirement that you need to maintain with certain standards. So there's another concept called principal agent problem. We will come into those stuff when we get into more details of these asymmetries, because this asymmetry is a very, very important area in financial markets, where you see the financial intermediaries facilitate to address this asymmetry problem. Even health insurance is same. The moral hazard is that towards the end of the financial year, if you are having a medical scheme provided by your organization, even if you don't have medical complications, you do a full body checkup. You go for mostly you see all this dental related. I mean, towards the latter part of the financial year is mainly driven by, because you have a facility, if you do not use it within that duration, that get lapsed. So people go and exercising. So it's not necessarily required, but because that facility is there, you do that. And you become risky because your parents are looking after you, right? But if you start kind of spending from your own pockets, you probably be a little more careful. So these are all possibilities, the moral hazard. You take more risks than what you should be. So for that, financial markets could sign contracts with restrictive covenants. So even if you go for a medical insurance, the insurance agency would sign with certain conditionalities, right? So that itself gives some information on the basis of what you have disclosed to them. So anything happens outside that, probably not covered. But it's very challenging because you know your health better than anybody else. So the asymmetry being addressed by financial markets much more efficiently than direct finance structures that you could think of. So this asymmetry could happen through adverse selection or moral hazard. Now you know what is adverse selection, what is moral hazard, right? So one is before the transaction, one is after the transaction. So these things to be dealt by the financial markets efficiently. Then with respect to indirect finance, okay, another very important functions they perform is financial intermediaries allow small savers and borrowers to benefit. Otherwise, small timers would get wiped out in financial markets. But financial intermediations allows them because they can pool, like a number of small investors can pool their investments and demand a big asset. So these are the unit trust, you probably know, mutual funds. What they do is, on your own, you can't buy because there may be conditionalities, minimum investments. And also when you buy big, you can demand good price for your investment. Whereas if you are a small time, it's like wholesale versus retail. So when you buy wholesale, you have a better price. So similarly, the financial market facilitate small timers to benefit. They get most of the small timers, and even there's no identification of small timers when it comes to those funds being pooled through a single account for facilitation. So this happened in indirect finance through financial intermediaries. So this actually promotes a bigger role to indirect finance in financial structure. Any questions?
Sir, hello.
So you see generally the major liabilities and assets of financial intermediaries.
Hello.
The assets
Hello.
are often the loans or investments, but the
Hello.
liabilities are all deposits, right? So when it comes to depository institutions, all what you see is deposits are not your funds, it's somebody else's. So it's a liability. You have to pay when they demand. But your assets are the loans that you extend. So when the financial funds, the borrower has to repay, but probably you have entered into contractual arrangements. Then you have contractual saving institutions. These are life insurance, fire, casualty. These are property insurance, right? Then you see pension funds, retirement funds. So the liabilities are the premiums paid by the policyholders or contributions by both employees and employees, like EPF, ETF that we are talking of. So what are the assets? They're investments. When you look at investment intermediaries, the liabilities are the shares mutual funds issues, units from another perspective, or shares to investors. or bonds for that matter. These are liabilities. You have to honor them when the investors demand. The assets are against their investments plus loans. So these are the ways through which you see the primary main assets and liabilities you see in financial intermediaries books. This may vary from country to country, but generally these are the ones everybody is having in their books. There may be very unique specific ones based on the markets in which you operate. This you don't need to worry about the volumes or the values. These are changing, right? So these change with the economic size, the economic developments and things. And in today's context, these values are much bigger, right? Then you see regulation of the financial system. So you have already recognized that asymmetry is a problem. Through asymmetry, you would create adverse selection, moral hazards. These are biggest challenges in any financial market or a financial system. So there's a regulation everywhere. So you find financial markets are one of the markets which has regulation. And to some extent, some argue the financial markets are the ones mostly regulated. I mean, there are other sectors also in economy, for instance, the defense, law and order, that's been much more regulated. No one can enter into that except possibly the governments, right? But what you are basically seeing is among the economic activities, financial markets remains one of the mostly regulated there for various reasons. But the prime purpose of this regulation is to make sure the asymmetry being reduced. So to increase the information available for market participants, stakeholders. This is very, very important role of regulation. Through information availability, the regulation actually tries to reduce the possibilities of adverse selection and moral hazards. And also they look at so-called the misbehavior by parties in the financial markets, like insider trading. So abusing the possibilities of information. So some informations are very pricey. That information might make opportunities for you to benefit immensely. For instance, you are having access to informations of management decisions. Let's say one of the top blue chips, they are going to get a very rewarding contract with a government, or for that matter with a foreign project that's to be introduced. So that would definitely push up the price of that particular blue chips shares trading in a stock market, let's say, the possibility. So what it means is that information is very pricey. So this information is known to a very senior level of decision makers of that firm, or for that matter, the parties to that contract in the other side, for instance, the government. So if somebody is having this information and make use of this information by purchasing now when the prices are not yet reflective of this information, he would be buying at a price that is expected to increase with that information going out. So that makes that information to be publicly announced, and obligations on the part of those listed entities by Securities Exchange Commissions being protected to great extent through various ways of reviewing. So the requirement on the part of these listed agencies, listed companies in exchanges is through Securities and Exchange Commissions is that you have to make, as soon as there is a possibility of a discussion, you have to make a public announcement. As soon as you enter into a contract, you have to make a public announcement, right? So to make sure the transactions by board of directors and their immediate family members being required to be revealed, there are various ways of looking at it. And similarly, there are the other information. When it comes to economic matters, policy decisions, interest rate decisions, investment decisions by the governments, and fund inflows, outflows to the government coffers. So these all kind of, information is very pricey and required to be regulated. And also from another perspective, speculation also to be addressed. People speculate, right? Certain people are also occupying certain positions would actually bring credibility, confidence to the market. So if there's something like that, to that effect, people start speculating things. People start speculating on the economic direction of macro variables. So to address those, you have to more or less provide information through which you can reduce the impact of those speculations. So the financial regulation that you see in financial markets and the financial systems are mainly to increase the information which are available for markets to make informed decisions than asymmetry-based decisions. So the asymmetry-based decision would not benefit the entire market, but only a handful of market participants. So the regulations try to minimize them and to address them through making information available to all. So that's the kind of a major role regulations play. And through regulation, the financial markets are expected, the soundness of financial intermediaries through various arrangements. So you see, when you wanted to become a financial intermediary, you have entry barriers. You can't just open a financial intermediary like another business entity you open in an economy. No. You have to have a minimum capital requirement. So that itself makes the investors responsible because they have to invest. Now it's 5 billion rupees in Sri Lanka if you want to get a license of a financial intermediary. This has to gradually increase based on the requirements. So you have a process called chartering process. So through which you actually do the background check in terms of even the people who are taking major responsibilities of a financial intermediary. Who are the board of directors? So there's an arrangement called assessment of fit and proper. Right? So this does not mean that you are assessing whether he is physically fit or not. No, that's a different ball game altogether. But fit and proper assessments actually screen the senior management or the board of directors, how credible and how they have conducted themselves over the past, whether they have any the criminal records, they have any reputational issues, they have done anything that harms the prospects of their engagement as a financial intermediary management, right? So that itself makes parties to the senior management decision makers in a financial intermediary has to come with a reputable background and with required, sometimes the required qualifications. You will be having investment, so not necessarily a paper qualification to that effect, but at least the credibility in terms of his conduct. So the management might require certain specializations that required, of course, some amount of acceptance, the ways through which the acceptance being built. So the entry is a screen through a process, and everyone can't just get into a financial intermediary in business. Then you see disclosure of information. That is also very much a part of a regulation of financial systems. If you are establishing a financial intermediary, you have to have information disclosure requirements. Even if you have established financial intermediary, every financial intermediary that requires to publish their balance sheets or the financial statements, audited, non-audited, after a given duration of end of a financial year, within, let's say, 3 months. This time horizons also might vary through regulations, but generally, you have to have the financial statements published within, let's say, 90 days of closure of a financial year, non-audited, and audited within a certain duration again. So these are the disclosure. Even if there is a change of management, you have to publicly announce. And you can't say that the CEO is changing tomorrow unless it's a unfortunate and unavoidable circumstances. You have to have in advance this being announced to the market, and also you have to announce the replacement, who is going to take over. So based on that information, investors would think, oh, whether I require to keep my investments with this financial intermediary, or I'm not happy with the person who is going to take over, so I will pull out my investments to some other financial intermediary. This all comes with the reputation and the confidence of its background and things that he has established. So that's very important. Then there's a restriction on assets and activities the financial intermediaries could engage in. You cannot let financial intermediaries to continuously take risks beyond certain capacities. So the regulators would be mindful of these. You can let financial intermediaries to, let's say, put all their investments in one type of asset classes. For instance, some financial intermediaries would like to invest in agriculture. Everything in agriculture. Sri Lanka has cycles of floods, then drought. So during those periods, those investments would really get hit. So you might limit your assets, cannot move into one type of economic activity. Let's say 1/5 of your asset cannot move into one type of economic activity. You basically put restrictions on these asset classes to minimize the risk arising from volatilities in financial markets. Then you see deposit insurance. It's compulsory in today's context. So all the financial intermediaries have to have a deposit insurance arrangement. So you probably require to pay a premium. That's a different ball game. So what they do is they charge from your return a certain share for deposit insurance. So in the event of a failure, you have a fallback up to, let's say, 1 million. So it's an insurance cover. So then you have limits on competition, but these branching limits, restrictions on interest rates, like things are of the past. Still, that could come in, interest rate restrictions, but the branching and things, it's now limited. Also, with people who are increasing the awareness in the financial markets, they're also mindful, as I was mentioning, higher the return, higher the risk. So some financial intermediaries try to entice people by providing you foreign travel, electronic gadgets, and many types of other enticing marketing arrangements, but effectively with the understanding people have, they are mindful now. But there's a segment of the market, still they get swayed by this type of marketing gimmicks or possibilities. But these are now getting limited to great extent in today's context. So this broadly, the discussion with respect to the financial structures. So what I'm going to say here is this is a very important topic. You get a lot of insights into the discussions that we have in coming lectures, also integrated to the concepts and understanding of this. So the financial system, either direct or indirect, has its own benefits, but mostly the indirect finance systems have a lot of benefits in today's context. And you will see the numbers also in coming lectures in terms of how those been factored by the financial markets. So with that note, we can move into the next lecture, next chapter for discussion. Any questions that you have?
Hello. Hello.
I'm seeing a message where I don't hear your queries.
Hello.
And I'm just wondering because it's been enabled here. So if you have that problem, you can actually type the query so I can quickly follow it up in clarifying before we move into the next discussion, next topic that we are having. Please use the message board if you are having difficulty in communicating your query there. So you are checking the syllabus. I thought you have already, you can see that in the financial, I mean the IBSL, this stuff itself, it's there. So that information is, I mean, that's public information as far as I'm aware of. So IBSL has these details in the website itself, or you can send a message to the administration where they communicate with you all. So you will get the details of the syllabus. But to some extent, some areas in the syllabus, as I was mentioning, you probably not cover during the discussions due to time elements. That's also possible, but broadly, I mean, it's been covered and discussed. And then there are certain areas, the priority and the importance being given based on the developments in the global financial markets, particularly with respect to the economics of money and monetary policy, that discussions that we are having here. So these details you can we talk about all the interest rates, how interest rates work, money supplies, quantitative easing, all kind of things is part of the course, and it's you will come across as we move on here. So that's general details, and with respect to these things, general areas of discussion, you can cross-check with the details already there in the website, the course guidelines and the course programs with details of these subjects and things. Yeah. Some sites of details that you see in the supplement, I'm not precisely restricting myself to one particular site to get information, but generally you can have financial literature and financial and money market and the monetary policy related information in Investopedia. That's there, so that generally clarify. And then the financial literature of JSTOR that has, and then we also look at the Harvard Business Chronicle, that's also there. So these, you don't need to kind of be specific there. You can just Google it and understand it, because you are not looking for, my understanding is not looking for a precise literature that, of course, if some of you wanted to do further studies, it's really worth, yes. But for the time being, to understand that's sufficient. General reference is sufficient. And if you are so keen, as I was mentioning, Frederick Mishkin's textbooks is more than sufficient for this program. And reading of financial press and understanding of those financial concepts. Any edition of 6th or beyond is fine. I think first lecture I have covered most of these things. So you can see the first lecture. There's a slide 1 or 2 that describes some of these questions that some of you are interested in. So that would be very helpful, I believe. So we are now heading towards the next chapter of discussion. I believe the IBSL has shared this presentation by now. Unfortunately, they could not load this to the system yesterday, but this is also an area where some of you might already have some knowledge, and I believe that knowledge is more conventional way of knowing what is money and what is the role of money and things like that. But there are elements that we discuss here is bit unconventional, and that would be useful in kind of defining things going forward in monetary policy and financial markets. So what you are basically seeing is, I mean, there are different periods of history. For instance, before the US Revolutionary War, okay, mainly the money in US are Spanish doubloons. These are silver coins that were also called pieces of 8. So they basically break one coin into 8 pieces, in US during the periods prior to Revolutionary War. So because the occupiers at that time, mainly from Europe, a Spanish background, so they also had Latin America under control at that time, like the other parts of the world where the other European countries had occupations. So you'll see this period, and then of course before the Civil War, this towards latter part of 18th century, the principal form of money in US were not only gold and silver coins, but also paper notes. There were bank notes available, but remember, those not been issued by the government's Federal Reserve or anything, because Federal Reserve come into existence at a later stage, so by private banks in US. So what I mean to say is, at different stages of history, the evolution of money was manifold, but gradually it has moved towards a paper-based money from more or less precious metal-based structures. And today, you use not only coins and dollar bills. These are issued in the past by private arrangements, but by the governments now. Okay, and then you use today the instructions-based financial arrangement. So you instruct your account in the form of checks, whatever. It's nothing but an instructions. Or you directly now instruct to debit, credit, transfer, all they are electronically. So it's a movement, evolution that you are seeing beyond coins and dollars, now issued by governments all around the world, or governments affiliated agency, that's the central bank or monetary authorities in the world. Okay, so this money has different things at different times, as we were mentioning already. Okay, but it's been very important to the stakeholders all throughout, even today's context, even in the past, and understanding that even in the future. So the meaning and the role the money was playing in economic activities was huge, right? So to understand the effects of money on the economy, we need to understand exactly what money is. In this section, we try to start discussing definitions by exploring the functions of money, looking at why and how it promotes efficiency, economic efficiency, and also try to trace how its forms have evolved to even up to Bitcoins today, but I'm not much looking at Bitcoins because there is no consensus or agreement in terms of Bitcoins because of a lot of uncertainties revolve around those. And how money being measured. That's very important part of this discussion, measurement of money in the form of different monetary aggregates. So that would give you some insights into money supply process that you will come towards latter part of this program. Right. The other element is, as I was explaining all throughout, the handouts for respective classes being usually shared in advance. For some reason, IBSL could not share this handout that being shared on Thursday. So more or less, you can still follow, and they probably be sharing things in advance for your easy understanding. But what I'm simply saying is, some of these aspects you might have already heard, but the focus here is somewhat different because we are trying to kind of, prepare yourself to take some other interlinked chapters and course requirements in terms of economics of money and financial markets. So the measurement of money is also a part of kind of preparation here, and we would not necessarily look at the details of aggregation of money supplies and things like that, but general understanding of the big games that we would be coming across in coming lectures. So the meaning of money is very important, and you probably know already that anything that you come across in acceptance for payment for goods or services, or in the repayment of debt, sometimes this part, the repayment of debt, you might not come across in some of the explanations you are familiar with, I believe. But the acceptance for payment of goods and services, I have seen everywhere. That's very common in definitions that you will come across in money. So what matters here is we do not restrict ourselves for acceptance for payment for goods and services, but even your past obligations or the obligations that you have built up in the form of repayment of debt is important in today's definitions of money. So still this is a broader definition, right? You can again swim into minor holes within this and define, but broadly you can actually agree to the extent that the money is generally accepted in the form of goods, payment for goods and services, as well as in the repayment of debts. So that's reasonably all right in terms of defining for this particular program. And the stock concept of money is different from concept of wealth and income. For us, we might go beyond money, a stock of money, simply because the behavior of financial markets, if not the economics of monetary policy, would look at the expectations of economic agents that's derived from wealth and income. You will see that as we move on, why people demand more assets, why people demand less assets, as we go on and describe these things in coming lectures. What is interesting here is you look at wealth. It is the total collection of pieces of property that serves to store value. Even you see your real estate, your collections of arts, right? Your collection of precious metals. This all part of your wealth. So you have more, your ability to demand assets is greater. But the configuration here is how quickly you can convert them into money. The liquidity concept also would play a role, but taking all these things into the broader perspective, where you see in economics so-called other things equal, ceteris paribus conditions, higher the wealth, higher the demand for financial assets. And similarly, income is the flow of earning. It's a flow concept. You work today, I work here teaching you all, and per unit of time I get some income. So that's a flow concept that adding to already built up wealth I might be having. Okay, so the income is a flow concept, money is a stock concept. At any given moment of time, you have certain millions of money or certain thousands of money. So you can define those, but this is important to say that the message in financial markets and to kind of convert them into learning monetary aspects, you have to look at money and go beyond that in terms of building expectations. So that's why I have brought in so-called concepts of wealth and concept of income also into the equation. And these elements, functions of money, most of you all have already learned. But I will try to be a little more brief here. So you know money plays very important functions, mainly three. One is the medium of exchange. Okay, so when money is used to intermediate the exchange of goods and services, right, it is performing a function as a medium of exchange. But interestingly, from our perspective, of finding double coincidence of needs, effectively transaction cost. So to say that if you are a fisherman, you catch a very good fish stock from your efforts today, but you effectively want upcountry vegetables. You are a fisherman, you catch fish from the sea. So, but you like to have upcountry vegetables. So you have to find somebody who is selling upcountry vegetables, and also he likes to have fish, not inland fish, but sea fish. So the double coincidence of needs. And if you wanted to exchange this to so-called barter system, not barter sleepers, okay? You know this, it's a barter system, right? So where you have to find this party who is ready to sell vegetables in exchange of fish. So you need to carry the fish from seashore to the upcountry. So you require transportation, you require labor, and also you have to preserve the fish in its condition, some refrigeration. If you don't have refrigeration, by the time you take the fish to the upcountry, the fish would become something else. And also, the party who wants to buy fish from you probably requires the same type of fish that you are carrying. So the need of the parties to transactions need to match, and it has to coincide with one's requirement with the other. It's very challenging and actually increases the transaction cost in the entirety of this discussion. So the medium of exchange role played by the money would effectively take care of this problem. So you exchange it for a piece of something that's accepted in the market as a medium of exchange, whether it's a metal or paper money, irrespective of that consideration, people are ready to accept. Piece of ceramic, fine. You can exchange your catch to that and then have that and give it to anybody. You don't have a requirement to carry that and kind of trying to match the double coincidence. So again, the barter exchanges look at double coincidence of wants, whereas the elements of medium exchange would address that. Then to recognize a medium of exchange, that requires to be easily standardized. Right? So should not be like, if it is a ceramic, the clay should be of this grade, that grade. It's difficult actually. So that's why after a point, the usage of ceramic pieces as medium of exchange vanished. Standardization is troublesome. Then if you look at even the metals being used, standardization is to some extent possible, but has other transaction costing. You require some machinery to standardize it. That's also costly. And then we have to have acceptance. I mean, during different periods of the wars, even cigarettes been accepted by the prison inmates as medium of exchange. So some do not smoke, some smoke, but everybody gets certain amount of cigarettes in the prison. So for a hair massage, actually head massage to say, or a body massage, so other services, cleaning, and of course, even for the exchange of food, some might eat some food, they've been distributed, some not. They use the cigarettes in the prison. Similarly, there are periods where the acceptance of empty beer cans in Germany at times of hyperinflation, instead of paper money, that's had acceptance. So what I'm trying to say here is this acceptance also very important to become and make it a medium of exchange. So you see, standardization is important, acceptance is important, divisibility, piece of 8, we were talking about revolutionary period in US, the Spanish doubloons, they can divide into 8. So you can divide them and make accountable for certain value. So divisibility. That's why today you have 1, 5, 2, 10, 20, 50. In a way, you can divide those stuff. And the carry. So all these barter trade diminish because of the problem with carry. Sometimes you require to exchange one good with the other. You need truckload of goods to be carried for exchange of handful of some other good based on the accepted valuation in those economies at those periods. But to some extent, still barter trade, barter exchanges exist. For instance, oil for food, oil for tea, right? Oil for other exchanges. Because at today's context, through sanctions and things, sometimes the financial transactions across borders become challenging. So they had devised arrangements to do barter trades. So you exchange your goods that widely produced, that required by your country, with another product that's required by the other country. So this happens in today's context. And deterioration. You can't use certain type of products as a exchange, medium of exchange, simply because it changes its conditions very frequently. So you need something that do not deteriorate. So these are the elements that you come across in medium of exchange. So you have to figure out a medium of exchange that try to address these conditionalities, at least to some extent. Then you see unit of account. you should be able to a unit, you should be able to measure a value or cost of any financial assets or the services or goods that you are having it, right? You should be able to measure. It's a nominal, a monetary unit of measure, and through which you will be able to kind of define some valuation. And for that matter, even the valuation of your economy, your income, your assets, your wealth, all matters. We calculate GDP. Okay, your property value, all some way of measuring. And this should again reduces the transaction cost. Otherwise, you have to measure your economy, and you probably come out with 6 times of Himalaya. That's a kind of another way of measuring it. But the difficulty is we don't know what's inside the Himalayas. You have to do a lot of efforts in recognizing it, and would be difficult in measuring things of that nature. So the money has to be a unit of account. Measurability is very important. The other element is store of value. That means you should be able to save, retrieve, and exchange at a later time, and be predictably useful when retrieved. I mean, you have saved money today for the purposes that you envisage 5 years from now, for your expenses that you expect to have in terms of, let's say, a marriage or assets accumulation or higher education, all possible. So what matters here is the store of value needs to facilitate to save purchasing power over time. So what you save today, store today, would give you purchasing power over time. So to say that that needs to protect you from inflationary possibilities too. So that's why if you save today, you should be saving with some return that would look after the erosion arising from inflation, value erosion. There are other assets that also serves the purpose of storing value, precious metals, real estate, fine. But it could go high and low. But when you store value, that effectively go high or low in terms of real value, not necessarily nominal value. At least it will preserve, but real value would define in terms of inflation. Okay, so that's why it says money is the most liquid of all assets, but loses value during inflation. So you need to have some compensation in terms of inflation and protection. So you are not something that we discussed is new to you all. It has to be a medium of exchange, unit of account, as well as the store of value. So we will stop at this point. We will come back with evolution of the payment systems and possibly approaching to discuss the interest rates. That's very, very important area of discussion. So if you don't have any further questions, or if you have questions, please put it down in the screen so I'll be able to address. If not, we will stop at this point, and we would be able to in fact discuss from here. But if you have a question, I was told mic is not facilitating you to raise the voice. So if you can put down in the message board, I'll be able to address if you have any question. If not, we will stop at this point, and we will start our discussion next week. Stay safe. Thank you.